So the end of the financial year is almost upon us here in Australia, and in today's video we are going to be breaking down the basics on tax loss harvesting or tax loss selling to offset some of the gains that you may have had across your portfolio with some of your losses. We're going to break it down into very easy to understand steps. There's been a lot of talk about this over the last year or so, especially from a lot of guru investors that I follow, Managed Bribe being one of them. Also there's some speculation around Charlie Munger with him reducing his position in Alibaba as well. Could be a tax loss reason there, but nothing's come out solid on that. So I've recently returned from Japan to a stack of mail, which a lot of that is from both the ASX and the NZX with regards to dividend reinvestment plans that I have set up, and also a number of other things that I need to get on top of. Thankfully, I am signed up to Sharesight. Now, Sharesight is today's sponsor for the video. I do have an affiliate agreement with Sharesight. I'll leave a link in the description below. But honestly, come the end of the financial year, Sharesight is a savior for me. Now, when it comes to my investing, I'm always looking for ways to automate and streamline and make things a lot easier so I can clear them out of my head. I don't have to think about, the dividend reinvestment plan, or whatever it may be. Once I have it set up, I have a system in place that will keep on top of that. And especially when it comes to tax time, it's an absolute headache. I don't enjoy taxes, most people don't, but I do like to have a good basic understanding of what I can do to minimize those taxes. So that's what we're going to be breaking down in today's video. So here we are over on Sharesight's blog, and we're just going to quickly go over a fantastic blog article written by Angela Thompson here, which breaks down the basics on tax loss selling for Australian investors. This is written very recently, only on May 24th. Just going to have a quick look at some of the highlights on here, then we're going to go over to Sharesight itself and simulate this exact example that she uses in her example here. Little disclaimer before we get into it. Like I said before, everything we discuss today is purely for informational purposes only. Don't use this as specific product recommendation or taxation or financial advice. Definitely speak to someone that is a lot more specialized in this area than me. This is more just a very basic overview of it, and then you can do your own further research on this as well. So basically, tax loss selling is a strategy that investors can leverage to minimize their net capital gains during a financial year for tax purposes. Now, obviously, we all want capital gains, but it's the nature of the beast. We do sometimes often incur capital losses. Even myself, I'm not immune to these. So this could be maybe a strategy that you may want to implement within your own portfolio. We have seen a lot of super investors this last year discuss this, especially with around some Chinese equities as well. Tax loss selling, or tax loss harvesting, what they quite often refer to it in the US, involves selling investments that have incurred capital losses in order to net out or offset capital gains realized during that year. We're going to have a quick look at this example that Angela uses here. So now she says, let's say you're lucky enough to buy CSL, which is listed on the Australian Stock Exchange back at the beginning of 2012, when it was trading for around $32. Now it's currently sitting around $272. So you've incurred a total annualized return of around 23%. In turn, you also brought into Retail Food Group around the same sort of time, and you've also had a pretty big capital loss on that investment as well. Actually, you brought this in around 2014, currently trading at around 5 cents a share. So now let's jump over to Sharesight, and I've actually put this into Sharesight. This is a very similar example to this, so you can see what I'm talking about here. Then we'll have a quick look at the report. So this is a very simple portfolio which I've made just from that example that we just went over. So CSL, the current price is around $273.50, and Retail Food Group is trading just below 5 cents there. This is just for this year that we're looking at as of 1st of Jan 2022. This is the total returns we've had. So we've actually had negative 5.48% just for this year. Whereas if over the long term, the value of CSL is currently at $85,058.50, whereas Retail Food Group is only at $105. So now let's move on over to the report section of Sharesight. Now you do get access to some of these basic reports in the free version of Sharesight as well, but if you want access to a lot more of these advanced sort of features, then you will have to go onto one of the paid subscriptions. Now I do believe this is only in the expert subscription which we're looking at today, but it's great if you just want to sort of run some different scenarios. If you're thinking about maybe selling some of your investments, both ones that you've had a capital gain on or some that you've had a capital loss on as well. Ideally, we don't want too many capital losses, but like I said, it's the nature of the beast. So here's the performance insight reports there. We're not going to be looking at those. Tax and compliance, which is super important. Today we're going to be looking at this one here, Unrealised Capital Gains Tax Report. So let's open that up and see what we have in there. So we're going to be looking at minimising our capital gains tax here, but if we go over to the far right here, we have this change sale allocation method. So we can actually open this up and have a look at, maybe we want to say first in, first out, last in, first out, maximising our gains, minimising our gains, and minimising capital gains tax. Today we're going to be focusing on minimising our capital gains tax. So we'll cancel out of that. So here we have CSL, the golden goose within the portfolio. So we brought these in the hypothetical situation. I don't have either of these holdings in my own portfolio. So 10th of Jan 2012, we bought 311 at a cost basis of just shy of $10,000. Currently today, trading at around $88,000 with a $78,722.09 gain. So that's the long-term capital gains because we've held these for longer than a year. Capital losses unrealised. Both of these unrealised. I haven't sold out of either position as yet. This is just to run a different sort of scenarios, maybe if you want to consider selling. So retail food group, purchased on 15th July 2014. Total 2,170 shares. Cost basis of just over $10,000. In today's market value of $145.39. So that's a capital loss. This is unrealised. Look, this may return. Hard to say. Look, I'm not going to say either way. But that's a capital unrealised loss of $9,856.61. So now if we go down to the summary here, we have capital gains on shares applicable for other short-term gains. So now we've held both these equities here for longer than 12 months, so we're eligible for a 50% discount on that. Now there may be some differences depending if you're investing through your super or through a trust or through a company or whatever it may be, but if you're investing as an individual, you will get a 50% reduction on any capital gains if held those equities for longer than 12 months. So capital gains on shares applicable for discount method, the long-term gains. So the long-term gain that we've had on CSL is $78,722.09, like we saw back up here. Now if we want to less the capital losses available for offset, which is the retail food group, the $9,856.61, so that will be deducted from those long-term gains, which will bring us down to $68,865.48. Now less that capital gains discount concession amount of 50%, so we take another $34,432.74 away from that, and we are left with $34,432.74. So this is the component where you would have to pay capital gains tax on the $34,000. Now it depends how much you've earned this previous year. Also want to consider that as well. That's just a very basic overview on that, guys. If you've got any questions or anything there, definitely drop it in the comments below. But like I said, everyone's situation in this is different. What you've earned this year may be different to what I've earned. You may be investing through a company, through a trust, through a self-managed super fund, whatever it may be. There's different tax things that you want to consider before selling out of an equity or buying more or whatever it may be. So definitely a few different things to look at there. This is just great for running a few different scenarios. Avoiding wash sales. Okay, so this is something that you definitely don't want to be caught up in. So in 2008, the Australian Tax Office, the ATO, issued tax ruling TR 2008/1, which specifically outlaws arrangements where, in substance, there is no significant change in the taxpayer's economic exposure or interest in the asset, or where the exposure or interest may be reinstated by the taxpayer. So in other words, the ATO prevents investors from selling a stock in one financial year to take advantage of capital loss event, only to buy that stock again in the new financial year. This is known as a wash sale. So definitely be a bit careful around this if you're looking at just doing this. I know in the US they have a 30-day period where they can't buy that same stock again. I'm not too sure how that works here in Australia. I've had a quick look and I couldn't figure out if it was something longer than 30 days or anything like that. Definitely if you do know that, drop that in the comments below because it'd be great to share and good for my information as well. But that's just a very quick touch on wash sales there. Now I hope you guys got some value there. If there's anything else you'd like me to go over in further detail within Sharesight, definitely drop that in the comments below. Keeping on top of maybe dividend reinvestment plans or capital gains or currency fluctuations, Sharesight takes care of everything. Now you may be able to do this through maybe Excel if you're a gun on Excel or some document somewhere. Myself personally, Look, I have a basic understanding of how to drive Excel, but by no means can I drum up different spreadsheets to cover all this. So that's why I highly recommend Sharesight. Now, there is a small cost, especially if you jump on into the paid plans, or you can have up to 10 holdings for absolutely no cost whatsoever, until you sort of want to step up and you maybe have more than 10 holdings, or you want to get access to some of these different reports that we broke down in today's video. I'll leave a link in the description below. Till next time, we'll catch you in the next video. Cheers, guys.